everybody. Welcome to another episode of Ardent TV. I have with me
Joseph Accardi. I'm the principal broker here at Ardent Mortgages, and
my name is Thomas Strathman. I'm the marketing manager here at Ardent Mortgages. And today, we're going to talk about debt consolidation. Everyone's favorite topic.
What are my thoughts on debt consolidation? Well, that's a big part of what we do here at Ardent Mortgages. We do it for multiple reasons. One of the biggest reasons is to improve credit, to improve cash flow, as we've mentioned in many other videos.
Okay, so some of you might be asking at this point, maybe you're in a situation where you have some debts. Is it a good idea to consolidate your debts into your mortgage?
Typically, it's an excellent idea to consolidate your debt from a high interest rate to a lower interest rate. Typically, the mortgages are secured, so they're conventionally a much lower interest rate than your credit cards, loans, other things like that. So yes, it's going to save you money, and it's going to clean up your credit.
Okay, so do we have any clients that you can talk about that, we may have done something similar in the past that turned out really well for them?
Every single one of our clients. That's what we do here. So the benefits to the borrower are, as I said, cash flow and credit. And I'll explain really quickly how that works. When you have a credit card that's reported to the bureau, if you're carrying a balance on the credit card, if the balance is over 50% of the limit, it has a negative impact on your credit score. So by paying off the credit card and keeping the credit card open, you're moving, for example, a 24% interest rate down to, let's say, even at a worst case scenario, a 12% interest rate, which is half, but typically we're looking more at like 4, 3.5, something, depending on what you qualify for again. That's huge interest rate savings. And then the credit card is reported to the bureau with a $0 balance because you're keeping it open. And that has a very positive impact on your credit score on a monthly basis.
Awesome. So are there any debts that you shouldn't consolidate? Is there something that you should avoid? What's the situation?
Vehicle loans are a tough one. The issue with the vehicle loans is they typically have a much lower amortization or term for the vehicle loan. So if you have a car that you're going to be paying off in 5 to 8 years, depending on how you've set up your financing for it, it may not make sense to move it into something that you're paying off for 30 years or 25 years. But again, that depends on the cash flow situation. If you're paying $700 a month for a $20,000 vehicle, and you can take that $700 and move it to a couple $100 a month, and you need the cash flow, then it does make sense. So everything is situational.
So what you're saying is you have to look at the whole picture before you really make any decisions.
That's correct. Yeah.
Or is there like a minimum dollar amount? Like, what if you're saying you're carrying $5,000 in unsecured debt? Does it make sense to go out and try and get a consolidation loan, or is there like a threshold?
That's a good point. There is a cost to doing a refinance, from penalty to if you're going to an alternative lender or a private lender, there's lender fees and broker fees. If you're going to an A lender, there aren't, but you still have the appraisal. So you have to look at the overall cost of borrowing and compare that to how much you're saving.
Is all debt bad? That's another interesting question. Or is debt a bad thing inherently?
This
probably should have been the first question. We could splice this up and put that at the beginning.
Sure, but that's a really tough question to answer. People like to call things, label debt, good debt and bad debt, et cetera, et cetera. All debt is both good and bad. We kind of touched on this in a previous segment that we did. So we're going to call them segments, video episode.
Whatever.
So we talked about how private mortgages, as an example, don't report to the credit bureaus, and there's pros and cons to that. That doesn't make it good or bad. So credit cards, again, high interest, large balance on a credit card isn't necessarily bad. It's a bad debt when the balance is over 50% of the limit. That's when it becomes something that hurts the credit bureau. That's right, and that's what you can say when you want to say good or bad. It's bad when it impacts your credit in a negative way. So any type of credit can do that, even a mortgage. A mortgage may not directly impact your credit score, which it does as well, but you can obviously go into default if you're not paying it properly. Yeah. So any type of credit.
Debt comes with risk.
Debt comes with risk. That's a good way to put it.
So skydiving.
That's
You're not going to put the label bad for skydiving unless you...
Right. It's for some people and not for others. And the same thing applies with the debt. The typical rule of thumb, what everybody wants to see, and I've said this before, is 2 trades, $2,500 a piece, and then you want a minimum 2-year history on that for reestablishing credit. That's what you're looking at for good credit.
Okay, so what does the whole debt consolidation process look like? What happens when somebody says, I've got $50,000 in credit card debt, can't handle this anymore, I need help? What's the solution?
What's the process that we
what does it look like working with us?
So what we do, and not every brokerage does this, and maybe I shouldn't even be sharing this, but I guess I'm going to.
This is the secret sauce.
It's not the secret sauce, but it's going to give away some of some good tips for other brokers, which isn't a bad thing. If you are another broker out there, I strongly encourage you to adopt this. But the first thing that we always do is we put together a cost savings analysis for the borrower. So if the deal doesn't make sense, we walk away at that point. There's a lot of brokers out there that will just
do the deal for the client.
For the client, yeah. So a very good point, of course.
Yep.
So what we do is we take a look at the total debt, how much the clients are going to be saving, all the costs associated with the deal, and if there's a positive savings for the borrower, we move forward with the deal. If it's negative, this doesn't make sense, we try to find another option. So that's step one. Mm-hmm. After we do that, we send that off to the borrower. They either say, we're interested in proceeding or not. If they're not interested, that's also the end of it. If they are interested in proceeding, then we submit it off to the lender, get an approval, get the commitment documents back out to the borrower. They sign it all back to us. Then we fulfill all the conditions of the commitment, ordering the appraisal, verifying income, getting the mortgage balances, getting the payout balances, all of that stuff. And then the deal gets submitted to the solicitor for instruction.
And then debt gets paid off, life gets better.
That's the first part about it. That's the other thing. That's not where we end with the borrower either. Mm-hmm. We actually keep working with them, stay on top of them to make sure that their credit is improving. If there's anything else that gets in the way of the credit, we step in at that point and adjust. And ideally, we want to graduate the clients from wherever they're currently at to whatever the next positive step is for them. So if they're with a private lender, you move them to an alternative lender, then back to the banks, and then help them pay down their mortgage as fast as possible so that they're mortgage free. And then the other thing, if they're interested, we offer them the investment product.
So what are the downsides to consolidating your debt? Are there any real downsides?
If you're not saving money, it doesn't make sense. If you are saving money, it does make sense.
Okay. So
that's the answer.
So if you go through the cost savings analysis and
so the downside
expenses
would be,
to going through the process still makes sense at that point, then
there's
no reason not to do it, right?
So we look at two things when we do the cost savings as well, just to elaborate on that a little bit. We don't just look at the monthly savings, we also look at the overall weighted average of the interest on the total debt. So the mortgage and all the other components of the debt. Sometimes you can be at a break-even point after 1 year, but if we're improving the credit, then it still makes sense to move forward. The downside would be even if we consolidate all the debt and you're still not saving money and your monthly interest rate is higher, that's the downside, right?
Yeah.
Your overall interest rate, not your monthly interest rate. So
fantastic. Hopefully that answered some of your questions, if not all your questions about debt consolidation. If somebody had some more questions or wanted to talk to us, what do they got to do?
You tell them, because this is your thing. Subscribe, post, do all those things. At the bottom, they're all there.
Comment, like, subscribe to the video. If you want to contact us, reach out to us at artofmortgages.ca. You can give us a call.
You can't put me on the spot with those types of questions. That's
What would you tell somebody if they were like, hey, how do I contact you to work with you?
Find me on, no.
Find me on Twitter.
Yeah, find me on Twitter.